The great inflation of the 1970s was not a lightning strike. It was a slow fever that weakened economies year after year, quietly dissolving trust in money, until societies realized that stability itself had become uncertain. Prices did not explode in a single moment. They crept upward relentlessly, embedding themselves into contracts, wages, expectations, and political behavior. By the time policymakers acknowledged the scale of the problem, inflation was no longer an episode. It was a regime. To understand how this happened, one must begin not in the 1970s, but in the triumph that preceded it. The post-World War II era delivered what many believed to be a solved problem: macroeconomic management. Governments had learned from the Great Depression. Fiscal stimulus, monetary accommodation, and welfare expansion produced decades of growth, low unemployment, and rising living standards. Inflation existed, but it was modest and predictable. Stability appeared permanent. This success bred confidence, and confidence bred complacency. By the 1960s, a new belief had hardened among policymakers that inflation and unemployment could be traded against each other. The Phillips curve offered a seductive promise: higher inflation could buy lower unemployment. For democratic governments, the incentives were obvious. Employment wins elections. Inflation erodes purchasing power slowly and diffusely. Central banks lacking independence accommodated fiscal ambition. Monetary discipline became negotiable. The United States embodied this shift. The Vietnam War and the Great Society programs expanded simultaneously, financed without sufficient taxation. Deficits widened. Money supply grew. For a time, productivity growth masked the imbalance. Inflation rose, but not alarmingly. Confidence held. The international system amplified the problem. Under Bretton Woods, the dollar was anchored to gold, and the world anchored to the dollar. This arrangement relied on American restraint. By the late 1960s, restraint failed. Dollars accumulated abroad faster than gold reserves could support. Foreign confidence wavered. In 1971, the United States suspended gold convertibility. The anchor broke. What followed was not immediate collapse, but drift. Without gold, monetary policy became more flexible and more political. Inflation accelerated gradually. Policymakers searched for culprits: unions demanding higher wages, corporations raising prices, speculators distorting markets, foreign producers exporting inflation. Few acknowledged the deeper cause: money had lost its constraint. Then came the oil shocks. In 1973, and again in 1979, geopolitical upheaval sent energy prices soaring. Oil was not just another commodity, it was the foundation of industrial life. Costs rippled through transportation, manufacturing, and food. Inflation jumped sharply. Growth slowed. Unemployment rose. The economy entered a state previously considered impossible: stagflation. This moment shattered post-war economic orthodoxy. Inflation and unemployment rose together. The Phillips curve failed. Policymakers were intellectually unarmed. Central banks hesitated. Tightening risked recession. Accommodation risked inflation. Political pressure favored delay. Wage and price controls were imposed, distorting signals and creating shortages without restoring credibility. The most dangerous development was psychological. Inflation expectations became embedded. Workers demanded higher wages in anticipation of rising prices. Firms raised prices preemptively. Long-term contracts incorporated inflation clauses. Money lost its role as a stable reference point. Inflation fed on itself. The social consequences were corrosive. Savers were punished as real returns turned negative. Fixed incomes eroded. Debtors benefited temporarily, encouraging leverage. Inequality shifted unpredictably. Trust in institutions weakened, not because prices rose, but because no one believed they would stop. Money ceased to function as a reliable store of value. By the late 1970s, inflation had become normalized. Policymakers spoke of managing it rather than defeating it. This was the most dangerous stage. When society accepts inflation as inevitable, discipline collapses. Monetary credibility evaporates completely. The Great Inflation was not confined to the United States. Advanced economies across Europe and beyond experienced similar dynamics, though with different intensity. The common thread was institutional weakness. Central banks lacked independence. Fiscal policy dominated. Political time horizons overwhelmed monetary restraint. Inflation persisted because confronting it required pain. History reveals a crucial insight. The Great Inflation was not caused by oil alone, or war alone, or the collapse of Bretton Woods alone. These were accelerants, not origins. The root cause was the erosion of monetary credibility. Inflation persisted because people expected it to persist. Once expectations shifted, policy became trapped. Inflation, history teaches, is as much psychological as mechanical. Money loses value not only when supply expands, but when belief in restraint disappears. The Great Inflation marked the moment when that belief cracked across much of the developed world. Standing inside that decade, few could imagine its resolution. Inflation felt permanent. Institutions felt weak. The idea that central banks would deliberately induce recession to restore credibility seemed politically impossible. And yet, history would demand precisely that. The consequences of the Great Inflation would extend far beyond the 1970s. Its eventual defeat would redefine central banking, elevate price stability as a primary mandate, and leave a generation permanently scarred by the memory of unstable money. But that reckoning would not come easily. It would require leaders willing to prioritize long-term credibility over short-term comfort, leaders willing to accept unemployment, recession, and political backlash to restore trust in money itself, a choice that marked a decisive break with the assumptions of the post-war era and forced societies to confront the true cost of inflation. Once it becomes embedded in expectations, a cost that could no longer be ignored as prices rose year after year and confidence drained away, pushing economies toward a moment when inflation was no longer merely high, but intolerable. A moment that would culminate in a confrontation between policy and reality. A confrontation that forced a reckoning that few policymakers were prepared to face, because defeating inflation required reversing every instinct that had guided economic management for a generation. The Great Inflation did not end through gradual adjustment or clever compromise. It ended through confrontation. By the late 1970s, the cost of inaction had become undeniable. Inflation was no longer eroding quietly. It was distorting everything it touched. Long-term planning became impossible. Investment horizons shortened. Productivity suffered. Trust in government promises collapsed. Money itself felt unreliable. For society to function, something fundamental had to change. That change arrived in the form of monetary resolve. In the United States, it took the appointment of Paul Volcker as chairman of the Federal Reserve in 1979 to break the inflationary psychology. Volcker understood that inflation was no longer a technical problem, it was a credibility crisis. Expectations had to be crushed, not managed. Words were insufficient. Only action painful enough to convince the public that inflation would not be tolerated could succeed. The Federal Reserve tightened monetary policy aggressively. Interest rates soared. Credit contracted. Recession followed. Unemployment rose sharply. Entire industries struggled. Political backlash was fierce. Farmers drove tractors around the Federal Reserve building in protest. Legislators demanded relief. But the Fed did not relent. This was the defining break with the post-war consensus. For the first time, a central bank prioritized price stability over short-term employment and political comfort. The message was unmistakable: inflation would be defeated, even at the cost of recession. Slowly, expectations shifted. Wage demand softened. Long-term contracts stabilized. Inflation fell. The pain was real, but so was the result. By the mid-1980s, inflation had been tamed. The Great Inflation ended not with relief, but with exhaustion. Society accepted the cost of discipline because the cost of disorder had become worse. The consequences of this episode reshaped economic governance for decades. Central bank independence became doctrine rather than exception. Price stability emerged as the core mandate. Credibility became the most valuable asset a monetary authority could hold. The memory of the 1970s disciplined behavior long after the crisis faded, but this victory carried its own legacy. Fear of inflation became embedded. Policymakers prioritized stability, sometimes at the expense of growth. Financialization accelerated as low and stable inflation encouraged leverage and risk-taking elsewhere. The Great Inflation did not disappear, it changed form. The deeper lesson of the 1970s is therefore not that inflation is always the greatest threat, but that credibility once lost is extraordinarily expensive to regain. Inflation becomes dangerous, not when prices rise, but when society stops believing they will stop. If this story of the Great Inflation changed how you think about central banks, inflation fears, or economic discipline, share what resonated with you. And if you want to continue exploring how moments of policy failure reshape financial history, follow the channel and stay with this journey, because money remembers what societies forget, and the cost of forgetting is always paid with interest.